A family in the 22% federal tax bracket that maxes an HSA for just 10 years could save about $19,250 in federal income tax on contributions alone, based on the 2026 family HSA limit of $8,750. That is money most people leave on the table because they pick a health plan by comparing one number, the monthly premium. Stick with me, because there are 3 cheaper numbers that actually decide whether the high deductible plan wins. I read the fine print so you don't have to. Here is the trap. An HDHP is defined for 2026 as having at least a $1,700 individual deductible or $3,400 family deductible, with a maximum out-of-pocket limit of $8,500 individual or $17,000 family for in-network care, per the IRS. HDHPs usually carry lower premiums but higher deductibles and out-of-pocket maximums than a traditional PPO. If you only compare premiums and ignore that higher exposure, you can underestimate your real cost by thousands of dollars a year. Here is the concrete version. Suppose the traditional family plan costs $10,000 in premiums, and the HDHP costs $6,000, a $4,000 premium difference in the HDHP's favor, adapted from white coat investor logic. But the HDHP family out-of-pocket max might be $17,000 versus $8,000 on the PPO per the 2026 IRS limits, which is $9,000 more worst-case exposure. In a bad medical year, you save $4,000 in premiums, but could pay up to $9,000 more out of pocket, leaving you $5,000 worse off that year before HSA tax benefits. Move one takes under 30 minutes. Open your employer benefits portal or the insurer's website and download the Summary of Benefits and Coverage, or SBC, for both the PPO and the HDHP, since these are federally mandated. For each plan, find 4 numbers: the annual premium you pay, the deductible, the coinsurance rate, and the out-of-pocket maximum, which for a 2026 HSA-qualified HDHP cannot exceed $8,500 individual or $17,000 family per the IRS. Then add premiums plus the out-of-pocket max to get the most you could spend in a disaster year, and write both totals side by side. Move 2 is where the money is. The IRS lets a family enrolled in an HSA-qualified HDHP contribute up to $8,550 in 2026, or $4,400 for self-only, plus an extra $1,000 catch-up if you are 55 or older. Plug your coverage type and federal marginal tax rate into a free HSA calculator, like the Doctored Money HDHP versus non-HDHP tool. At a 22% rate, maxing the family limit of $8,750 saves you $1,925 in federal income tax this year alone. And every dollar goes in pre-tax, grows tax-free, and comes out tax-free for qualified medical expenses. Stack that up over time. A family in the 22% bracket that maxes the $8,750 limit saves $1,925 a year. And over 10 years, that is roughly $19,250 in avoided federal income tax on contributions alone, based on the 2026 IRS limit and a constant tax rate. That figure counts 0 investment growth. If you invest the HSA instead of spending it, T. Rowe Price notes an HSA can offer better tax benefits than both Roth and pre-tax retirement accounts when used for qualified medical costs, because it stacks a deduction, tax-free growth, and tax-free withdrawals. Here is the mistake that quietly costs the most. Many HDHP members never max the HSA, turning a high-deductible plan into high-deductible with no tax help. If that same family contributes only $2,000 a year instead of $8,750, they save just $440 annually versus $1,125, foregoing $1,285 in tax savings each year. Over 10 years, that is $14,850 in lost federal tax breaks on contributions alone, per the 2026 IRS limits, before you even count the decades of tax-free compounding they gave up. Before I get to the last part, which is the most counterintuitive piece of this, let's fix the other blind spot. Most people only picture the worst case, but you also need your normal year. Pull last year's total spending from your insurer's portal or your explanation of benefits. Then run it through each plan's deductible, copays, coinsurance, and out-of-pocket max. If this is useful, subscribe. The next breakdown is already coming. That gives you the realistic cost, not just the disaster scenario. Here is the piece people miss. The tax savings are guaranteed. The worst case is only a risk. For our example family, $4,000 a year in premium savings is $80,000 over 20 years. And even 3 bad max-out years at $9,000 each only claw back $27,000, leaving about $53,000 ahead. Add roughly $38,500 in HSA tax savings over 20 years at $8,150 a year in the 22% bracket. And the total is around $91,500 before any investment growth. This is general information, not personal advice. And the white coat investor is right that there is no rule of thumb. You must run your own numbers. Let's run it back fast. Compare total cost instead of premiums. Map each plan's worst-case year using the SBC and calculate your real HSA tax savings with a free calculator. Then estimate a normal year from last year's explanation of benefits, and weigh the guaranteed tax break against the odds of a bad year. Do all 5 and you'll know whether the HDHP plus HSA actually wins for your family, not just in theory. Do this before open enrollment closes, because once you enroll, you are usually locked in for the year. Next, I'm covering how to invest your HSA so it becomes a tax-free retirement health fund instead of just a checking account. If you want to catch that, subscribe so you don't miss it. Run the numbers, capture every dollar of employer match, and let the tax code do the heavy lifting.